Lesson 26. Building your own strategy. So far in this course, we've been running other people's strategies. You downloaded a sample, you pointed Freqtrade at it, you ran a backtest, and you got numbers back. That is a perfectly fine way to learn the tool. But at some point, if you stay in this game long enough, you start to feel a particular kind of frustration. The sample strategies are what they are. They don't quite express what you actually believe about the market. You tweak a parameter here and there, but the core logic is someone else's, and you can feel it. This lesson is the turning point. We're going to build a strategy from scratch, from an idea in your head all the way to working code. And I want to be clear up front about what that actually means. Because there is a myth that custom strategies are an advanced topic reserved for people who can code well. They're not. Writing a strategy in Freqtrade is mostly about being clear in your own head about what you want to happen, and when. The code part is small. Start with the idea, not the code. Every strategy begins as a sentence. A plain, ordinary sentence about the market. Something like, I think when the short-term average of price crosses above the longer-term average, the trend has shifted up, and I want to be in. Or, I think when an asset gets pushed too far too fast, it tends to snap back, so I want to buy oversold conditions. Or, I think breakouts on heavy volume are real, and I want to ride them. That sentence is the strategy. Everything else is just translating it into something the machine can execute. If you can't write the idea down in one sentence, you don't have a strategy yet. You have a vibe. Vibes don't backtest well. So before you open a code editor, write the idea down. Then for both sides of the trade, answer two questions. When exactly do I want to enter, and when exactly do I want to exit? Be specific. Not when it looks good, but when this condition is true. The exit side is where most people are vague, and vagueness in exits is where money leaks out. How a Freqtrade strategy is structured: once you have your sentence, you translate it into a Python class. A Freqtrade strategy is just a class. It inherits from a base called isStrategy, and you fill in 3 methods that the framework will call for you. That is the whole shape of it. The first method is called populate indicators. This is where you compute everything you need to make decisions. Moving averages, RI Bollinger Bands, volume averages, whatever your idea requires. The framework hands you a data frame of recent price history for a trading pair. You add columns to it, and you hand it back. Think of it as preparing your workspace before you sit down to decide. The second method is populate entry trend. This is where you write your buy logic. You look at the indicators you just computed. You write down the conditions under which you'd want to enter, and the framework marks those candles with an entry signal. If on a given candle your conditions are all true, the bot will consider buying. The third method is populate exit trend. Same idea, but for selling. You write down the conditions under which you want to exit, and the framework marks those candles with an exit signal. That is it. 3 functions: indicators, entry, exit. When you read other people's strategies and they look intimidating, look again. Underneath all the math, there are just 3 blocks of conditions. The other knobs beyond those 3 methods. A strategy has a handful of settings at the top that control things that aren't really about the signal itself, but about how you trade it. The time frame. This is the candle size the bot will work on. 5 minutes, 15 minutes, 1 hour, 1 day. Shorter time frames mean more trades and more noise. Longer time frames mean fewer trades, but cleaner signals. Pick one that matches your idea. A mean reversion idea on the 5-minute chart and a trend-following idea on the daily chart are completely different animals. The stop loss. A single number that says how much loss you'll take on any trade before the system cuts it. -3% is a common starting point. This is your seatbelt. Don't drive without one. The minimal ROI table. ROI stands for return on investment. This is a clever little feature. It is a table that says, as a trade gets older, demand less and less profit before exiting. So you might say, take profit at 10% immediately. But if the trade is still open after 30 minutes, accept 5%, and after an hour, accept 3%. The idea is that an aging trade that hasn't hit your target is occupying capital, and you want to free it up. Set this high if your exit logic is doing the real work. Set it lower if you want the table to do the selling for you. Trailing stop. Once a trade is in profit, you can have the stop loss ride upward with the price, so a winner doesn't turn into a loser. You can figure when it kicks in and how far below the peak it sits. This is one of those features that sounds fancy but is genuinely useful. Winners giving back gains is one of the most painful things in trading, and trailing stops are a clean way to prevent it. Startup candle count. When the bot starts up, it needs some history to compute indicators on. If your slowest indicator uses 50 candles, you ask for at least 50 here. Otherwise, the first few signals will be garbage. These settings live at the top of the file as plain variables. You set them once and mostly forget them. A first real strategy, the crossover. Let me walk through a concrete example so this stops being abstract. The idea, in one sentence, when the fast-moving average crosses above the slow one, the trend is turning up, so I want to be in, and when it crosses back below, the trend is turning down, so I want to be out. Classic, simple, older than the markets themselves. Now, let's add a small filter. The crossover signal fires a lot, and many of those fires are noise. So I want to ignore signals where RSI is in the oversold zone, below 30, because a fast-moving average cross while the asset is already crashing is probably a false start. And I want to require volume to be above its recent average, because a crossover on thin volume doesn't mean much. So the entry becomes three things together. The fast EMA crossed above the slow EMA, RIC is between 30 and 70, and volume is above its 20-period average. All three have to be true on the same candle. The exit is simpler. Either the fast EMA crosses back below the slow one, or RIC goes above 70, meaning the asset is now overbought and the move is probably tired. That is a complete strategy. In code it is a few lines, per F function. The first time you write it, it'll feel almost too simple. That is fine. The best strategies I've ever seen are simple. Complexity is what people reach for when they don't trust their idea. When you backtest this, you'll get a report. Number of trades, win rate, total profit, max drawdown, average profit per trade, best and worst trade. Don't fall in love with the total profit number. Look at the win rate and the drawdown together. A strategy with a 55% win rate and a 3% max drawdown over 3 months is interesting. A strategy with an 85% win rate and a 25% drawdown is a bomb waiting to go off. A second strategy, the reversion. Now let me show you a different philosophy. Because crossover strategies are trend following, and trend following fails in sideways markets. The idea, when an asset is pushed far below its recent average, it tends to snap back toward that average. So I want to buy when price is stretched too far down, and exit when it has returned to the middle. To measure too far down, I'll use two things together. RI below 30, which says momentum is exhausted to the downside, and price below the lower Bollinger Band, which says price is more than 2 standard deviations below its recent mean. Either one alone isn't enough. RI alone fires too often in a real downtrend. The Bollinger Band alone can fire during a legitimate crash. Together they say, stretched and exhausted. That is a stronger statement. For volume, I'll again require it to be above average, because a snapback needs participation. And I'll add one more filter. I want price to still be roughly near its 50-period EMA. If price is 30% below the 50 EMA, the asset is in a serious decline, and mean reversion is wishful thinking. The exit, either RIC climbs back above 50, which is the neutral midpoint and means the reversion is complete, or price touches the middle Bollinger Band, which is the rolling mean, the natural target. Either one closes the trade. Notice how different this is from the crossover. The crossover wants movement and continuation. The reversion wants stillness and snapback. They're almost opposites, and they'll shine in opposite market conditions, which is, by the way, the whole reason to have more than one strategy. A portfolio of strategies is more robust than any single strategy, because different markets favor different logic. The indicators you'll reach for. Let me quickly name the indicators most strategies end up using, grouped by what they're for, because you'll see these names constantly. Trend indicators tell you which way price is moving. Moving averages, simple and exponential. MACD, which is essentially the difference between two moving averages plotted with its own signal line. ADX, which doesn't tell you direction, but tells you whether there is a trend worth following at all. ADX above 25 means a real trend. Below 20 means chop. Oscillator indicators tell you when something has gone too far. RI, ranging from 0 to 100, with 30 and 70 as the classic oversold and overbought lines. Stochastics, similar idea, different math. with 20 and 80 as the thresholds. CCI, which measures deviation from a moving average and uses plus or minus 100 as its extremes. Volatility indicators tell you how much price is moving. Bollinger Bands, which widen and narrow around a moving average based on recent volatility. ATA Average True Range, which gives you a single number for how much an asset typically moves per candle. ATR is wonderful for sizing stop losses dynamically. A volatile pair needs a wider stop. A quiet pair can use a tighter one. Volume indicators tell you whether a move has participation. Plain volume compared to its moving average. OBV on balance volume, which accumulates volume on up days and subtracts it on down days, giving you a sense of whether buyers or sellers are leaning in over time. That is the toolbox. Most strategies you'll ever write combine 2 or 3 of these. Trend plus oscillator, oscillator plus volatility, that kind of thing. The mistake to avoid is stacking 5 or 6 indicators on top of each other until they all have to agree. Because at that point you've built a machine that almost never fires. The workflow, so here is how development actually goes in practice. You start with the idea, written down. You translate it into the 3 functions. You run a syntax check first, because typos happen and they're cheap to fix. Then you run a quick backtest on 30 days of data, just to see if the thing produces a reasonable number of trades. If it produces 0 trades, your conditions are too strict. If it produces 200 trades in 30 days, your conditions are way too loose, and fees will eat you alive. Then you look at the actual trades. Freqtrade can plot your entry and exit points on a price chart. And this is genuinely one of the most useful features in the whole tool, because numbers lie and charts don't. You'll see immediately where your strategy is buying stupidly. You iterate. Maybe RI below 30 is too tight. Try 35. Maybe the volume filter is too aggressive. Try 1.2 times average instead of 1.5. Small changes, one at a time, and you retest each. Once you have something that looks reasonable on a month of data, you expand. Backtest on 3 months, then 6. Test on different periods, a bull run, a bear market, a sideways chop. A strategy that only works in one of those is fragile. You also test out of sample, meaning data the strategy has never seen. If it falls apart on fresh data, you've overfit and you need to simplify. Then dry run, paper trade it for 1 or 2 weeks against live market data. This catches things backtesting can't: signal repaint, latency, exchange quirks, the gap between the clean historical data and the messy live feed. Only then, if everything still holds up, do you go live, and you start with the smallest position size you can stand. The mistakes everyone makes. I want to end with the 4 ways this process goes wrong, because they're predictable and they're everywhere. The first is look-ahead bias, also called using future data. This is the sneakiest one. If your entry condition uses information that you couldn't have known at the time of the candle, your backtest will look amazing and your live results will be catastrophic. The classic example is shifting price data forward to peak at tomorrow's high. It sounds absurd, but it sneaks in through subtler paths too. The rule is brutal. Every decision on a given candle must use only data from that candle and earlier, no exceptions. The second is over-optimization. You run the parameter tuner. You find a combination that produces a 200% return in backtest. You get excited. It will not survive contact with live markets. The signal that it is happening is usually that you've tuned parameters more than 5 or 10 times, chasing a better number. Stop. Simplify. Use out-of-sample data to check yourself. The third is ignoring fees and slippage. A strategy that trades 50 times a day and makes 0.1% per trade sounds great, until you realize each trade costs you 0.1% in fees. And now your edge is gone. Always configure realistic fees in your backtest, and be honest about slippage on less liquid pairs. High frequency is the enemy of retail traders, because fees are a flat tax on every transaction regardless of size. The fourth is signal repainting. Some indicators, when computed, can change their past values as new data arrives. If you build a strategy on a repainting indicator, your backtest will show perfect entries that you could never have actually taken, because the indicator only looked that good in hindsight. Stick to stable indicators like EMA, SMA, SHRI. Test signal stability by checking whether the signal on a historical candle is the same now as it was when the bot first generated it. What good looks like a good strategy has a few recognizable traits. The logic is explainable in one sentence, and you can defend it on theoretical grounds, not just, it tested well. The backtest is stable across different time periods, not just the one where it happens to shine. The trade frequency is reasonable, somewhere between a few a week and a few a day, not dozens. The drawdown is survivable. The risk per trade is bounded by a stop-loss you actually trust. A bad strategy is the mirror image. Logic you can't explain, or that requires 6 indicators to all line up. A backtest that looks perfect on one period and falls apart on others. Trading frequency so high that fees dominate. No real stop-loss, or a stop-loss so wide that one bad trade wipes out a month of gains. The single most useful test I know is this. Could you explain this strategy to a friend in 30 seconds, and would they nod? If yes, you probably have something. If you find yourself gesturing and saying, it is complicated, you've built a Rube Goldberg machine, and the market will find the weak joint one last thing. When you build your first strategy, resist the urge to make it impressive. Make it boring. Make it small. A simple idea, executed cleanly, tested honestly, traded with discipline, beats a clever idea, executed messily almost every time. The people who last in this game are not the ones with the most complex strategies. They're the ones whose strategies they actually understand. That is lesson 26. In the next one, we'll go deeper into multi-time frame analysis, which is how you combine a slow chart for context with a fast chart for entries, and it is one of the cleanest ways to improve the quality of signals without making the logic more complex.